Okay, let's unpack this. We're going to talk about the single most influential number in all of global finance. It's a number that determines if your savings actually grow or if they shrink, if a business can expand, and, if that house you want is even affordable. We're talking about the interest rate.
Yeah, and it's so often just boiled down to the cost of money. But that definition, it's deceptively simple, isn't it?
It really is.
We're actually talking about the fundamental mechanism that central banks use to steer entire economies. It's a concept that has seen some incredible extremes.
You mean swinging from, what was it, 800% annual rates in some places?
800% in moments of desperate economic crisis, all the way down to, and this is the really surprising part, dipping below zero in the last decade or so.
That volatility, that sheer drama, is exactly why we're doing this deep dive. We've gone through a comprehensive stack of source material, all focused on this one concept. And our mission for you, the learner, is to give you a complete foundational understanding. We're going to start with the absolute basics.
Right, we'll hit the crucial difference between nominal and real value first. Then we'll move through the mechanics of how central banks try to control it, including some of those extreme policies we just mentioned.
And then finally, we'll dissect all the little pieces, the granular components, that determine the specific rate you get from, say, your local bank.
Exactly. The goal here is to leave you not just informed, but genuinely fluent in the language of interest rates. We want to clarify all those essential distinctions and show you exactly how this one number impacts everything.
The big macroeconomic outcomes, output, employment.
And, critically, the long-term stability of your own savings and your pension fund.
Okay, so let's establish that foundation. What is the core definition we're working with here?
At its most basic level, the interest rate is the amount of interest due per period. And it's expressed as a percentage of the amount that was lent or deposited or borrowed.
So it's the price of capital, but it's also, in a way, the price of time.
That's a perfect way to put it. It reflects a borrower's willingness to pay a premium to have money now instead of having that same amount of money in the future. The lender, on the other hand, gets compensated for delaying their own spending.
Right, so think about a big company. When it decides to take on debt, maybe issue some bonds or get a loan, they're making a very specific, calculated bet.
A gamble, really.
Yeah, a gamble.
Mm-hmm.
They're betting that the money they borrow will generate a return on their investment that's, significantly greater than the interest rate they have to pay back.
And that gap, that space between the cost of borrowing and the return they generate, that is the engine that drives economic growth. If they can't make those interest payments, that gap shrinks or just disappears entirely.
Which leads directly to financial distress, default, and maybe even bankruptcy.
Which is why the interest rate is basically the gatekeeper for investment decisions across the entire globe.
Now, we have to remember that the rate itself, that percentage, is only one piece of the puzzle. The sources remind us there are 3 other variables that work with the rate to determine the total interest you end up paying or receiving.
And these are crucial for anyone taking out a loan. First, you've got the principal sum. That's the actual amount you borrowed in the first place.
Okay, so the lump sum.
Exactly. Second is the compounding frequency. This one is huge. It's how often the interest calculation is applied to your balance. Interest that's compounded daily is way more expensive than interest compounded annually, even if the stated rate is identical.
And the third one is just the length of time, the total duration of the loan or the deposit.
Yeah, a 30-year mortgage, even at what seems like a low rate, racks up a staggering amount of total interest compared to, say, a 5-year car loan. The time horizon makes all the difference.
So all 4: principal, rate, frequency, and time, they all work together.
They create the final cost of capital. Now, going back to this idea of it being the most influential number, it's really important for you to know that when you hear financial news anchors or economists say the interest rate, they're usually using it as shorthand.
Shorthand for a very specific rate.
Right. They mean the central bank's policy rate.
So in the U.S., that's the Federal Reserve's federal funds rate, the FFR.
Yeah.
In the U.K., it would be the official bank rate from the Bank of England.
Precisely. And because those rates dictate what it costs commercial banks to lend to each other overnight, they just cascade through the entire financial system. They become the foundation, the base rate that everything else is built on.
And you hear a bunch of other terms that are all related to this, like the repo rate, the prime rate, the discount rate.
And they all describe slightly different mechanisms. The rate banks lend to each other versus the rate they offer their best corporate customers. But they all fundamentally link back to that one central cost of borrowing.
Okay, that sets our foundational language. Now we can move into what is Arguably the most critical distinction for anyone who wants to really understand the headlines.
This is where we get into the difference between nominal and real rates.
And this is the moment you realize that the rate you see posted on your savings account can often be, well, an illusion, especially when you factor in inflation.
It's paramount, this distinction, because the buying power of our money is constantly shifting. The nominal interest rate is the easy one. It's just the stated percentage you see on the loan agreement. It's the number, no adjustments.
But the real interest rate is the one that actually matters for your wealth.
Yes, because it accounts for inflation. The real rate measures your interest by comparing the final sum against the buying power of that money when the deal started. It's about what you can buy with it, not just the number of dollars.
So here's the aha moment, right?
Mhm.
If you're earning 5% nominal interest on your savings, but inflation is also 5%,
Then your real interest rate is 0. You've gained absolutely no buying power. You're just treading water against the current of rising prices.
and worse, if inflation is higher than your nominal rate, say inflation is 8% and your account pays 5%, then you actually have a negative real interest rate.
Your wealth is actively shrinking in real terms. Even though the dollar amount in your bank account is technically going up, it buys you less and less each year.
So we formalize this with something called the Fisher equation. Our sources give us the precise mathematical formula for it.
Right, which is 1 plus I, 1 plus P, 1, 1. And that's the academically correct multiplicative way to do it, where R is the real rate, I is nominal, and P is inflation.
But thankfully, for most everyday situations where rates are low, there's a much simpler way to think about it, an approximation that gets the logic across perfectly.
That's right. And that core logic is just simple subtraction. The real rate is approximately the nominal rate minus the inflation rate. So 3 INRX IPU.
That's so much more intuitive. It lets you just instantly gauge the real return on your money.
But there's an important detail here about when we apply this equation. It's used both ex ante and ex post.
Which means before the event and after the event.
Exactly. Ex ante is when you're projecting. If you're the Federal Reserve setting policy today, you have to use an expected inflation rate for the next year or two. You're forecasting.
And ex post is when you look back. A year later, you plug in the actual inflation that happened to see what the real interest rate truly was.
And the gap between that forecast and the reality is huge. If a central bank gets its inflation projection wrong, the real interest rate ends up being different than they intended, which can either overstimulate or over-tighten the economy. It's often the key to whether monetary policy succeeds or fails.
Okay, moving on from that core concept, let's quickly clarify a few other terms you might run into, like in consumer finance. Things like APR and AER.
Right, the annual percentage rate, or APR, you see on credit cards and car loans. But it's vital to know the difference between the nominal APR and the effective APR, or EAPR.
The EAPR is the real cost because it includes all the compounding and any mandatory fees, like an origination fee on a loan.
Yeah, the nominal APR often leaves those fees out, which can make the loan look a lot cheaper than it actually is.
And then there's AER, the annual equivalent rate, which you see on savings accounts.
AER is similar in that it factors in the compounding frequency, but unlike EAPR, it typically does not account for any fees for holding the account.
And finally, in the investment world, you have yield to maturity, or YTM.
That's a bond-specific term. It's essentially the total annualized rate of return you'd get if you bought a bond today and held it until the very end, until it matures and pays you back the principal. It accounts for all the coupon payments and the price you paid for it.
Okay. So we've defined the price of money. We've clarified the crucial difference between the stated rate and the real rate. Now we dive into the machine that actually controls this number, Section 3, monetary policy.
Interest rate targets are, without a doubt, the most powerful tool central banks have. They use them to try and manage that macroeconomic holy trinity: investment levels, inflation, and unemployment.
And the basic strategy is pretty straightforward, right? You cut rates to stimulate the economy.
Exactly. You lower rates, borrowing becomes cheaper, and that encourages firms to expand and consumers to, buy a house or a car.
And conversely, you raise rates when the economy is overheating and inflation's getting out of control.
You pump the brakes. Higher rates make borrowing more expensive, which slows down spending and investment, and hopefully brings inflation back into line.
But the sources are clear that this is a delicate balancing act. Keeping rates low for too long, while it feels good, can be really risky.
It can lead to economic bubbles. If capital is too cheap for too long, you can see a flood of investment into specific sectors, like real estate or the stock market, pushing prices way beyond their fundamental value. We all know how that ends.
To really appreciate the power of this policy lever, you have to look at the historical volatility. The numbers are, frankly, wild.
They are extreme, and they show just how fragile the value of money can be under pressure.
Our sources give us some incredible examples. The U.S. federal funds rate, for instance, it's been as low as 0.25%, but it also hit a peak of nearly 19% in 1981.
19%. That was Fed Chair Paul Volcker's shock therapy to kill the runaway inflation of the 1970s. Can you imagine trying to get a mortgage at that rate?
Unthinkable today. And the UK saw similar swings between 0.5% and 15%. But those are in relatively stable economies.
Yeah.
The real shock comes when you look at places dealing with hyperinflation.
Take Germany in the 1920s. After the Weimar Republic's hyperinflation completely destroyed their currency, they had to push rates up to almost 90% just to try and stabilize things.
90%. I mean, how does an economy even function?
It barely does, but that's nothing compared to Zimbabwe. In 2007, as their currency was becoming worthless, their central bank raised borrowing rates to 800%.
800. That's not even an economic policy at that point, is it? It's just a sign of complete collapse.
It's a desperate emergency measure. It's basically the central bank throwing its hands up and saying the formal monetary system has failed. Very little legitimate borrowing happens at that rate because inflation is probably running even higher. The economy just reverts to cash or barter.
Which puts another detail from the sources into context. It says that during the 1970s and 80s, interest rates on prime credit were higher than any previous peaks recorded since, like, the 1600s.
Yes, the source is emphatic about that. It says, since modern capital markets came into existence, there have never been such high long-term rates. That inflation fight in the late 20th century was an absolutely unprecedented global financial event.
So that shows the high end of the range. But the last 15 years have all been about exploring the other boundary, pushing toward the floor. Which brings us to the zero interest rate policy, or ZRP.
ZRP is when a central bank sets its target rate extremely low, near zero. And the main challenge it tries to deal with is something called the zero lower bound.
The ZLB. This is the traditional idea that you can't really push rates below zero, right?
Historically, yes. The thinking was, if a bank tried to charge you a negative rate, say, they take 0.5% of your deposit each year, you would just pull your money out.
And stuff it under the mattress.
Exactly. Because cash has a guaranteed return of exactly 0%. So hoarding cash becomes more attractive than accepting a guaranteed loss at the bank, which makes the central bank's policy ineffective.
And the U.S. used ZRP aggressively after the 2008 crisis, from 2008 to 2015, and then again during the COVID pandemic.
It's a signal that the economy is so weak, or the risk of deflation is so high, that the central bank has basically run out of its normal ammunition.
Which brings us to where things got really weird in the 2010s.
Yeah.
Actually trying to break through that zero lower bound.
And here we have to distinguish between two kinds of negative rates. Negative real rates and negative nominal rates.
A negative real rate, as we said, is actually pretty common. It's just when inflation is higher than your nominal interest rate.
Your purchasing power is shrinking. And when this is done as a deliberate government policy, it's called financial repression.
This was a key policy in the U.S. and the U.K. after World War II, wasn't it?
It was. Through the late 1970s, it was essential for managing the massive debts they'd accumulated during the war. It's a way for governments to inflate away the real value of their debt.
So it's basically a stealth tax on anyone who saves money.
That's precisely what it is. You keep nominal rates low, but you let inflation run hot. This guarantees a negative real return for bondholders and savers, which reduces the government's real debt burden over time without having to, explicitly default or raise taxes in a way that's politically unpopular.
It's not an obvious tax. It's a slow, confusing erosion of wealth that most people don't immediately trace back to a specific policy.
And the historical record shows how savers felt about it. The source notes that by the late 1970s, U.S. Treasury bonds were being called, pejoratively, certificates of confiscation. That tells you everything you need to know.
Okay, so that's negative real rates. Now for the most extreme measure. Negative nominal rate policy, or NIRP. This is where the central bank's target rate itself is set below zero.
Which, according to the zero lower bound theory, shouldn't really work.
So how did this idea even come about?
Well, we have to go back to the late 19th century, to a German merchant named Silvio Gesell.
Gesell. He proposed this as part of a free economy idea, right? Freigeld, or free money.
That's it. He saw the negative interest rate as a tax on holding money. His big concern was that if people just hoarded cash, the economy would stagnate, so he designed a system to force money to circulate.
He suggested issuing currency that literally expired.
Imagine a banknote with an expiration date. To keep it valid, you'd have to pay a small fee, maybe by affixing a stamp, to exchange it for a new bill. If you tried to hoard it, it would just become worthless.
Yeah.
That was the original, very clever solution to the zero lower bound problem.
And this idea wasn't just some fringe theory. It actually caught the attention of major economists.
Oh, yeah. John Maynard Keynes gave it a serious look in his masterwork, The General Theory.
And he liked the principle, but he dismissed it. Why?
He saw it as too difficult to administer at the time. The logistics of printing new bills, stamping them, it seemed too clunky for a national economy in the 1930s. Technology has obviously changed that calculation.
The thought experiments kept coming, though. The sources mention ideas like magnetic strips on bills to track how long they've been out of a bank.
And levying a tax based on that time. Or my personal favorite, the serial number lottery.
The one where you just announced that all bills ending in a certain digit are now worthless.
It's a brilliant thought experiment. You draw it once a year, and on average, cash hoarders lose 10%. It's a functional negative interest rate with almost no logistical overhead.
So these ideas were floating around for decades, but NRP actually moved from theory to practice in the last decade, mostly in Europe and Japan.
Starting in 2014, the European Central Bank went negative, charging commercial banks to hold their excess reserves. The Bank of Japan followed in 2016, specifically trying to break Japan's entrenched deflationary mindset.
And it wasn't just them. Sweden, Denmark, Switzerland, they all implemented NRP as well.
And there's a fascinating technical detail from Sweden. Back in 2009, their central bank, the Riksbank, set its main policy rate at 0.25%. But at the same time, they set their overnight deposit rate at negative 0.25%.
So they were actively penalizing banks for parking cash with them overnight.
It was more of a technical consequence at first. The deposit rate was automatically set a certain amount below the policy rate. So as the policy rate neared zero, the deposit rate just slipped into negative territory. But the crucial thing is they studied it and found it caused almost no disruption, which gave other central banks the confidence to try it more deliberately later.
And it wasn't just central bank rates. This bled into government debt markets, too.
Yes, during the European debt crisis, bonds from super safe countries like Germany and Switzerland were actually selling at negative yields.
Meaning investors were paying those governments for the privilege of lending them money, which seems completely backwards.
It is, but there were powerful reasons. First was just an intense desire for safety. A small, guaranteed loss was seen as a better bet than a potentially huge loss elsewhere.
And the other reason was speculation about the Eurozone breaking up.
Exactly. Holding a German bond was seen as a hedge. If the Eurozone fractured, Germany would presumably redenominate its debt into a new, stronger currency. So the negative yield was basically the price of an insurance policy against a total system collapse.
So rates are volatile, central banks have immense power, they can even go below zero. Let's now look at how those changes actually filter down into the real economy. Section 4, macroeconomic impact.
This whole process is called the monetary transmission mechanism. It's the how, the specific channels through which a central bank's policy change affects the broader economy.
And the first, most direct channel is investment behavior.
Right. If a central bank raises rates, it increases the cost of borrowing for companies. This immediately raises the opportunity cost of investing in new projects, like a new factory or more research.
So they run the numbers on a project, and because the cost of capital is now higher, the expected return might not be worth it anymore.
Precisely. They use a model called net present value, or NPV. A higher interest rate acts as a higher discount rate on future profits, making those future profits look less valuable today. If the NPV of a project drops below zero, the company scraps it.
So by lowering rates, the central bank lowers that bar, making more projects look profitable and stimulating investment.
The second channel is the asset price or wealth effect. This one is huge. Rate changes directly affect the prices of stocks and houses.
Okay, how does that work?
When rates fall, future corporate profits are discounted less, which tends to drive up stock prices. At the same time, lower mortgage rates make housing more affordable, increasing demand and pushing up house prices.
And this creates the wealth effect.
Exactly. When people see their 401k and the value of their home going up, they feel wealthier. And that feeling of security encourages them to save a little less and spend a little more, which is a massive driver of the economy.
The third major channel involves international differentials. This is about exchange rates and trade.
If the U.S. raises its interest rates relative to, say, Europe, International capital will flow into the U.S. to chase that higher return.
which increases demand for the US dollar, making it stronger.
And a stronger dollar makes U.S. exports more expensive for other countries while making imports cheaper for Americans. This directly impacts net exports minus imports, which is another core piece of the economy.
So all these things, investment, consumption driven by wealth, and net exports, they are the building blocks of what economists call aggregate demand.
And by steering that demand, monetary policy affects national output and, eventually, employment levels.
And that ties into the famous Phillips curve connection, the idea of a trade-off between unemployment and inflation.
In theory, yes. As you stimulate demand and push unemployment down, the labor market tightens. Companies have to pay higher wages to attract workers, and they pass those higher costs on to consumers in the form of higher prices, which creates inflation.
But that relationship has gotten a bit blurry in recent years, hasn't it?
It's become much more complex. We've seen periods of very low unemployment without the expected jump in inflation, which has made the job of central bankers much harder.
Now, let's bring this back to the individual. One of the biggest concerns today is how all this affects our savings and pensions.
The sources highlight this really unusual period from about 1982 to 2012, where we had this great combination of low inflation but pretty high returns on assets, especially bonds.
And this created a sort of dangerous complacency for pension funds.
It did. Pension consultants made these very optimistic assumptions. They figured they could get, say, a 6% long-term return, which meant they didn't need to hold as much cash today to cover their promises for 30 years from now.
But the era of ZIRP and NIRP completely upended that map.
It was devastating for them. Here's why. A pension's liabilities, the payments it owes to future retirees, have to be discounted back to today's value.
Using the current risk-free interest rate.
Exactly. So when rates are high, that future liability has a small present value. But when interest rates are pushed down near zero, the discount rate falls. And the calculated present value of that same future promise just skyrockets. All of a sudden, the fund looks massively underfunded.
Wow, so a decade of low rates acted like this silent, brutal accounting force on these funds.
And the problem for the individual saver is the same. Without returns that can significantly beat inflation, the real value of your nest egg is shrinking, not growing. The interest you get in a basic savings account today often doesn't even keep pace with inflation.
This whole discussion about charging interest, or earning so little you lose money, it raises this fascinating philosophical counterpoint. The idea of an interest-free economy.
It sounds radical, but the source defines it in a very specific way. It's an economy without a pure, risk-free interest rate component. And historically, this isn't that radical. Many cultures and religions, including Islam and aspects of Christianity, have had strong taboos against usury.
So a normal interest rate has four parts: pure interest, a risk premium, inflation compensation, and administrative costs.
In an interest-free model, only that first part, the pure interest, the charge just for the privilege of borrowing, is removed.
So banks could still operate and make a profit.
Oh, absolutely. They would just have to make their money from the other components. They could charge for administrative costs, or they could enter into profit-sharing agreements with the borrower. It's a different framework, one that's focused on sharing the risks and rewards of actual economic activity rather than just charging for time.
Okay, we've covered the central bank's hammer, but let's get specific. If the Fed sets a target rate, what determines the actual rate you get on your mortgage or your car loan? This is Section 5, the dynamics of private markets.
This is where we go from macro policy to micro pricing. The rate you see is built in layers, all on top of that base risk-free rate from the central bank.
And the sources break this down into four key components: the risk-free rate, expected inflation, a risk premium, and transaction costs.
The interplay between those is why your credit card rate can be 24% while a government bond might yield 4%.
So let's look at the factors driving those components. First is deferred consumption.
Just the basic human preference for having things now rather than later. Lenders have to be compensated for delaying their own gratification.
Second, inflationary expectations, which we know from the Fisher equation. Lenders need to be protected from their money losing value over time.
And it's important how those expectations are formed. The sources distinguish between rational expectations, where everyone perfectly predicts inflation.
Which never happens.
Right. And behavioral expectations, which is much more realistic. It says people use shortcuts, they're slow to update their beliefs, they have blind spots.
And that really matters for policy, because if people aren't updating their expectations quickly, The central bank might have to be much more aggressive with its rate changes to get the desired effect.
Then you have alternative investments. A lender can put their money anywhere. By lending it to you, they're giving up the chance to invest in stocks or real estate. So all these investments have to compete for capital, which drives up the required return.
And don't forget taxes. If your interest earnings are taxed, you'll demand a higher rate up front to make sure your after-tax return is still worth it.
There's also one other factor, a more political one: political short-term gain. It can be very tempting for governments to push for lower rates right before an election to create a short-term economic boost.
Which is the core argument for why central banks need to be independent to insulate them from that kind of political pressure.
Absolutely. But the biggest component, the one that creates the most variation, is risk and the risk premium. The lender is always taking a risk that you won't pay them back.
Whether it's an individual filing for bankruptcy or a company going under.
So the lender, who is generally risk-averse, charges an extra amount, the risk premium, to compensate for those expected losses across their entire portfolio of loans.
And there's also a maturity risk premium, right? A longer loan is seen as riskier.
It is. So much more can go wrong over 30 years than over 30 days. So a 30-year bond will almost always have a higher rate than a 3-month bill to compensate for that long-term uncertainty.
The sources get really technical here, listing 4 specific kinds of risk that lenders have to price in: repricing risk, basis risk, yield curve risk, and optionality. Let's slow down and unpack those. What's repricing risk?
Repricing risk is the danger that market rates change before your loan's rate can be reset. Imagine a bank gives you a 1-year loan at 5%, but 6 months later the Fed jacks up rates to 7%. The bank is stuck earning 5% while its own costs have gone up. They're losing money on that spread.
Okay, that makes sense. What about basis risk?
Basis risk is when two interest rates that are supposed to move together suddenly diverge. A bank might fund its loans based on one index but price them based on another. If those two indexes decouple, their profit margin gets squeezed unexpectedly.
And yield curve risk. We hear about the yield curve inverting all the time.
That's the risk. A bank's business model is to borrow short-term, like from depositors, and lend long-term, like mortgages. This works when long-term rates are higher than short-term rates. If the yield curve inverts, if short rates rise above long rates, their entire business model breaks down. Their funding costs more than their lending earns.
And finally, optionality. What's that?
Optionality is the risk that the borrower has an option that benefits them at the lender's expense. The classic example is prepaying your mortgage. If you have a 7% mortgage and rates drop to 4%, you'll refinance. That's great for you. But the bank just lost a high-earning asset and now has to reinvest that money at a much lower rate. They charge a premium up front for that risk.
That is a lot of risk to price in. But there's one more factor: liquidity preference.
This is just the general preference people and companies have for holding cash or assets that can be turned into cash quickly and easily.
And this preference is what creates the term structure of required returns.
Exactly. Cash is perfectly liquid. Any asset that's less liquid has to offer a higher return to convince you to tie up your money. A 10-year loan requires a bigger liquidity premium than a 1-year loan because your capital is locked up for much longer.
Although the sources make a great point that deep secondary markets, like for U.S. Treasury bonds, can reduce this cost. Even though they have long maturities, you can sell them instantly, which makes them feel very liquid.
That's right. So we can put all of this together in a conceptual market model.
The nominal interest rate, $1, is built from these different pieces.
Yes. It's approximated by the sum of the risk-free rate plus expected inflation plus the risk premium plus the liquidity premium.
So the rate you pay is the fundamental price of time, plus protection against inflation, plus compensation for the risk you'll default, plus compensation for the hassle of tying up the lender's cash.
That linear approximation, $1 plus PT plus RP plus LPP, is a great mental shortcut. The actual math is multiplicative because of compounding, but for most purposes, just adding them up gives you the right idea.
And finally, inside the banking system itself, there's the concept of the spread.
The interest rate spread is just the lending rate the bank charges minus the deposit rate it pays to savers. That gap is how the bank covers all its operating costs and makes a profit.
It's their entire engine.
It is. You can very rarely see a negative spread where a bank pays more on deposits than it earns on loans, but that usually only happens in very distorted markets or during a panic where they're desperate for cash.
Wow. We have taken a huge journey. We've traced the interest rate from a philosophical idea, the price of time, all the way to a macroeconomic lever of immense power,
Yeah.
and then down to a granular four-part pricing formula.
We really have. We started with the basic definition and the absolute necessity of using the Fisher equation to understand the real rate, the one that affects your actual buying power.
We then explored how central banks use policy rates, noting the insane historical volatility from 800% in hyperinflationary Zimbabwe to the financial repression of the post-war era,
Right.
when U.S. Treasuries became those so-called certificates of confiscation.
And we spent a lot of time on the radical modern policies of ZIRP and NIRP, seeing how the theory for negative rates goes all the way back to Silvio Gesell's idea of a tax on holding money, and how that theory became reality in Japan and Europe.
We then connected those rates to the real world through the monetary transmission mechanism, detailing how they affect corporate investment, create the household wealth effect, and impact trade through exchange rates.
And finally, we broke down that private market model, showing how your specific rate is built piece by piece, incorporating the risk-free rate, inflation, your personal risk premium, and the lender's need for liquidity.
What's the one thing that really stands out to you in conclusion, thinking about where this number has been and the politics behind it?
It's that the history here shows very clearly that governments will use extreme measures to manage their debt. The lesson of financial repression is powerful. A government can and will use negative real interest rates as a stealthy way to transfer wealth from savers to the state to reduce its debt burden.
And now we've seen them use negative nominal rates, NIRP, to explicitly change our mindset, to penalize saving and force spending. It's a deliberate act of financial engineering.
Which leaves us with this incredibly important final thought, something for you, the listener, to really mull over. If NIRP is designed to put a cost on holding money, to push you out of cash and into spending or physical assets, what is the ultimate theoretical limit? How deeply negative could rates actually go?
At what point does society just reject the concept of money as a store of value?
Exactly. If the reward for saving becomes a guaranteed loss, would we eventually just abandon money and prefer physical assets? Or could we, following Gesell's logic to its conclusion, even turn back toward an interest-free economy based on shared profits just to escape the confiscatory nature of extreme negative returns?
The interest rate, then, is not just a number on a statement. It is a mechanism of historical power, deeply tied to human behavior, political necessity, and the entire structure of our markets. That was an intense and surprisingly dramatic deep dive.
Indeed. We look forward to diving in again soon.